By the end of this video, you'll understand why a silver short squeeze would look nothing like the headlines people expect. Short squeezes are not conspiracy theories. They are documented market events. We saw one in 2008 with Volkswagen stock. We saw another in 2021 with GameStop. And in both cases, the real story was not the price spike. It was the underlying market structure that made that spike unavoidable. That same structural logic is what matters in silver today. Not price, not hype, and not headlines. To understand that, we need to start with what actually caused the Volkswagen short squeeze, not what people remember from the chart. In 2008, Volkswagen briefly became the most valuable company in the world. That did not happen because the business suddenly changed. It did not happen because demand exploded. And it did not happen because investors got emotional. It happened because of structure. A large portion of Volkswagen shares were locked up. Another large portion was quietly controlled through options. At the same time, hedge funds had built massive short positions, assuming liquidity would always be available. When the true availability of tradable shares became clear, short sellers realized something critical. They could not buy back what they had sold. At that moment, price stopped behaving normally. The squeeze was not driven by excitement. It was driven by forced buying into a structurally constrained market. Price did not rise because people wanted Volkswagen. Price rose because they had no alternative. GameStop in 2021 reinforced the same lesson. Different market, different participants, different catalyst, but the same mechanism. Too many shares were sold short relative to what could realistically be delivered when demand surged. Again, price did not lead the event. Structure did. Silver is not a stock, and the silver market is not the equity market. But the mechanism that creates extreme price moves is the same. It comes down to availability versus promises. In silver, the globally visible price is set primarily through paper markets. Those markets function on contracts, unallocated claims, rolling positions, and the assumption that physical metal will be available when needed. That system works until it doesn't. Here is the core silver forecast thesis. The market is not moving silver around. It is using it up. Silver consumed by industry does not cycle back the way shares do. It gets embedded into electronics, solar panels, medical applications, industrial processes. Once it leaves the system, it is not easily replaced. That distinction matters. This is where most people get misled. Markets do not warn you with price. You can have calm trading, stable prices, no headlines, no panic, at the same time that underlying availability is quietly tightening. That is exactly what happened before Volkswagen. Price did not signal danger. Structure did. The same is true in silver. In paper silver markets, multiple claims can exist on the same ounce. Delivery is the exception, not the norm. Most positions are settled financially. That is not fraud. That is how the system is designed. But it creates structural vulnerability when physical demand rises or supply tightens. Just like Volkswagen, just like GameStop, if a silver short squeeze occurs, it will not look like a stock chart going vertical overnight. It will show up first as higher physical premiums, longer delivery times, inventory drawdowns, and rising volatility without an obvious cause. The squeeze would be mechanical, not emotional. Price would not lead. Price would follow. This is critical. High price is not the signal of a short squeeze. High price is the result. The real signals are structural, shrinking visible inventories, persistent physical premiums, rising sensitivity to demand shocks, and volatility appearing without warning. Those are the signals that matter. So when people talk about a silver short squeeze, the mistake they make is watching the price and waiting for excitement. That is not how these events form. Volkswagen did not break because people got emotional. GameStop did not move because charts suddenly looked bullish. Both happened because market structure quietly reached a point where promised supply could no longer be delivered on demand. Price did not lead those events. Price revealed them. Silver works the same way. The visible price can stay calm right up until structure forces a repricing. Physical availability tightens. Delivery assumptions get tested, and volatility appears without warning. That does not require headlines. It does not require panic, and it does not require prediction. It requires structure, and when structure changes, price always follows, not because anyone decided it should, but because the market leaves it no choice. That is why the groundwork for a silver short squeeze is not built with excitement or high prices. It is built quietly, underneath the surface, in the mechanics of availability and delivery. And that is why watching structure, not chasing price, is how you see these events coming. We track these structural signals each morning as new data comes in. That's the silver forecast morning signal.